Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. Paul Winkler, along with Michael Sharpneck, talking money and investing. And getting into some of the things that you might think about doing with your finances during the holiday season. You made a comment, Michael, about something you might want to avoid. Mm-hmm. I hadn't really thought a whole lot about it. I remember there used to be a guy that did a show on the topic of crowdfunding, years ago. And it was a radio podcast. There are probably plenty of them out there still. What about, I don't know a whole lot about it. I would hear this guy talk about it to some extent, but crowdfunding, younger people, what's going on there?
Yeah, I've came across this recently. There's a lot of these newer investing programs, online investing platforms and apps. Mm-hmm. We've heard of like Robinhood and some of these, but there's ones that are specifically focusing on crowdfunding. It's not necessarily a newer concept, but they've kind of repackaged it. Okay. Fundrise is one of these companies, Realty Mogul. There's quite a few of these.
So is it, and I'm going to throw my ignorance out here. From what I understand, somebody comes up with a product idea, typically, and then what happens is they say, hey, I've got this product idea. I'll let you in on the ground floor of this deal. They may not pay you any return, but you might get like free copy of the product or something like that if it actually comes to fruition, or you'll get a subscription for a period of time, or maybe you'll get a discount, or isn't that kind of, there's something in it for you.
Yeah.
Albeit it doesn't seem to me that it's like an investment thing most of the time.
So they have a really wide range of products that you can get through. A lot of these are focused on real estate, actually. And
really?
Yeah, and they're
real estate?
On real estate, and they're actually repackaging. They're kind of remarketing REITs, essentially. A lot of them are they call them e-REITs, so electronic REITs. Some of them are kind of avoiding that word, even though essentially that's what it is. But it's essentially what they're marketing it as is like, the wealthy invest in real estate. All successful people have real estate.
Oh my goodness.
And but traditionally you need hundreds of thousands of dollars to be able to even start getting in on it. So we can crowdfund, and you have 1,000 little guys with $100 instead of one guy with $100,000, and you all are able to then crowdfund that money and take part in investing in different real estate projects.
See, I always get a kick out of that. The wealthy do this. Mm-hmm. And so often I have talked about on this show, if you follow the wealthy and how they invest in the stock market or how they invest in general, you'd be in big trouble. Yep. Because you look at the growth of just the lower performing area of the market, the S&P 500. If you look at that over 20, 30 years, and you look at the difference between that and the growth and the wealth of the wealthiest people in the world, you'll notice that the market beats them. Mm-hmm. So it doesn't surprise me that they try to market based on that association, guilt by association. I guess we come back,
right? Yeah,
we come back to that. But in reality, I think that the problem is there is so much risk of fraud in that particular area. From what I've seen, like the FTC, the Federal Trade Commission, I think even talks about this to some extent. But the idea is, are they really going to come through as some kind of a promise? And is it really a legitimate thing for investing for your future? I like learning from other people's mistakes as much as I possibly can. And I think this is an area where younger people that are looking at this as an investment option really ought to look at it and go, you know what, this kind of stuff has been done and tried before, it doesn't usually lead to much of anything that's worthwhile.
Yeah, there's huge amount of risk in it. I think younger people are really enamored by real estate in general right now. It's been so hot recently that they're really they think that they can try to get in on it and want to get the returns
which
there.
is so interesting because it's cooled down.
Yeah,
it's like every other trend we've ever seen where people don't get interested until the horse is out of the barn.
Right, at the peak.
People did not get interested in technology stocks in the 90s until it was like 1998, 1999. Now, I remember watching TV and just shaking my head and going, this is unreal. Now, when you see these big news channels on finance and they are reporting to you what a select sector is doing all the time, and new mutual funds are coming out in that particular area all the time, you know you're probably at a peak. You ought to be going, I think I'm going to back away from this. And, you take the real estate profession. I was talking to a real estate agent, and I was asking about the commission thing. He says, we're not really at risk personally in terms of how the real estate commissions, because what they're doing is they're saying that these different entities in the real estate industry are colluding to keep the real estate commissions high, and there ought to be more flexibility. It's, if everybody's setting prices, then government doesn't necessarily get terribly excited about that. But what he said is, we have always been flexible. We have always been negotiable. And that's the key. Well, if you have a lot of negotiating going on in that particular area, that real estate business, and let's say that there's less marketing of it being done because you've negotiated the benefits of selling the real estate down, that could have an effect. Interest rates having an effect for sure, as the interest rates have actually increased on mortgages. A lot of the deals are being done with cash now because people just simply don't even want to finance. Well, people run out of cash after a while. You have overbuilding in so many different cities around the country where they've overbuilt for the actual demand for real estate. At some point, what happens, and there have been builders doing this. I don't know if you noticed this, Michael, but what is happening with the builders around the country is they have actually put into the price of the project the financing, and they actually have lower financing costs than if you went out and bought an existing home. So that has actually driven the increase in the amount of inventory of brand new property, and you get more supply. What do you get when you have demand, which is staying the same, let's say? You get nothing but a drop in prices. So I think that is quite often the case, that people do get all enamored with something like that, and then it's usually at the wrong time. Sure.
Yeah. And that's one of the things they're doing with it too, is you may not have to invest directly in the real estate, but the debt. So they're crowdfunding the builder who's financing, some commercial building project. You become the one who's lending, you're crowdfunding the lending to that builder to build their project.
You're crowdfunding the lending to build the project. That just makes me nervous even thinking about it. Yeah. So, but that is, I think, just keep your eye on this, folks. Anything like that, private equity is another thing that comes to mind.
Yep.
When you don't have a lot of regulation, let me just put it this way. A lot of times we buck against regulation. We say it's a bad thing, it's terrible. But in investing, it really does protect investors. When companies have to put their data together, they got to put their balance sheets together, they got to put their financial information in there, they can put all of what they're doing out there to be scrutinized by a potential investor, so that when they put out the documents for a prospectus or whatever, then people can look at it and go, is this thing legitimate? When you have something like crowdfunding or private equity, you just have such a dark glass that you're looking through. You don't really know what you're buying. And when you don't know what you're buying, and when things are being hidden, it's ripe for you paying way too much for that thing that you're buying. And it's ripe for you losing money because you didn't know really what you had. I would stay the heck away from it, and I don't have a dime of my own money in that. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. We're back here on the Investor Coaching Show. Paul Winkler talking money and investing along with Michael Sharpnick up in the Goodlettsville office. Michael is a chartered financial consultant, retirement income certified professional.
There you go.
Registered professional. Oh, man, I'm so used to rattling off my own designations that I just blew yours. Anyway. So yeah, you were commenting during the break, not done with the crowdfunding thing yet. So what else did you want to say regarding that?
Yeah, well, you have all these companies that are marketing to younger people, all these investments. One of the things that it made me think of, like Taco Bell. Think outside the bun. They're trying to get you to think outside of stocks and traditional investing. And I was in that alternative investments. Yes. That was the hot thing around 2009, and you saw commodities being included in that, and so much of that stuff just absolutely tore up people's portfolios. And most of them, they don't know about it because they don't realize it, because they don't look at their statements. They don't even know what happened to them, is what I find. But yeah, when you see alternatives, you see commodities, you see that type of thing in your investment portfolio, private equity, all of that. What is this person doing? And I'm not paying any attention. Yeah, for sure. Yeah. There's nothing new under the sun. You talk about being in finance, kind of like being in a time machine. It's kind of interesting for me being a younger person in the finance industry and meeting with people of all ages and seeing the different perspectives. It's these things that are being marketed, these alternative investments, these real estate, this essentially repackaged REITs. It's nothing new, but it's being marketed to younger people as if it's this new, hot, trendy thing that you can get into, even though it's just something that's been around for a long time.
Yeah, there is nothing new under the sun. There have always been things, because if you look at the data on returns that investors have gotten investing in markets in general, or investing just period, it's abysmal. And I saw somebody brought in a statement, and it was a very small account. And they had a bunch of bigger things going on. They had some real estate investments and some personal property and things like that they were going to sell and downsize, and they were going to be okay. But it just amazed me, the stuff that they had done in the stock market. It was in investments, and they said, well, this thing was about the same account value about 20 years ago, about 23 and 25 years ago or something like that. I can't remember the exact number of years, but it was the same amount. And all I could think of is, who on earth was watching and paying attention to this thing?
Right.
And, it was basically money was moved into places at really bad times, and people chasing markets and chasing returns, and they end up being destroyed by it. So, yeah. But that, that's... I think there's certainly nothing new under the sun, and there's certainly that aspect where people repeat these things. I remember early on we would go and walk people through the types of risk. I used to do this regularly with people 20 years ago when I was doing a lot of paperwork and setting up accounts. I would bring people through the different types of risk, and I would talk about how we're avoiding those risks. Liquidity risk. And I would talk about, and if you look at these types of things, liquidity risk is a huge deal,
yep.
right? I can invest, I can put my money in it, but can I turn it back into money? Can I pull it back out and turn it into money? You talk about the costs. What are the costs to get in? What are the costs to get out? I don't know exactly how that works, but I would expect that there is some significant drag in that particular area that has not even been looked at by the regulators necessarily because it's such a small thing.
Right.
And it won't be really looked at until people have really lost a tremendous amount of money is what my experience with regulators. Look at what has been happened in the past in the investing world. And typically things don't get fixed until a lot of people have lost a lot of money.
Sure.
I was just looking online about it. It's the cancellation restrictions. Once you make an investment commitment for a regulation crowdfunded offering, you'll be committed to make the investment unless you cancel your commitment. I didn't realize that was a thing. That was under the SEC website. Valuation capitalization. I already covered that. I'm just looking at the SEC website on the thing. And valuation capitalization. It's how do you value this stuff? Remember back in 2008, we went through this whole mess in 2008. And you had this marked to market. Nobody had even heard the term before, hardly. And the idea of mark to market was, what is this supposed to be actually worth? And so many of the investments had a much higher value on paper than you could actually sell them for. So what ended up happening is you had properties, banks had properties. And on their books, the property was worth a high number. And in reality, because they couldn't liquidate it because nobody could buy anything because of what was going on in the economy and what was happening in the banking system, nobody could actually pay. And that's when you had TARP, when the government basically came in and bought up the properties. And it's funny because the government actually made money on TARP, which everybody thought that's the worst thing ever. But they bought the properties for a song and a dance. And then when the economy recovered and everything got better, they got their money back. But that was a huge risk at that point in time because nobody really knew what was going to happen. Another thing they bring up, limited disclosure. Like I said, you don't have SEC documentation. Early stage company may be able to provide only limited information about its business plan. You don't know. It's just you're throwing your money in a black hole. Investment in personnel. Early stage is also an investment in the entrepreneur. That's who's benefiting the greatest amount with this. Right.
Them and the companies making the markup, the kind of the marketplace of it.
And private equity sees somewhat of the same type of thing. It can be very, very fraught with risk. Possibility of fraud. I brought that up already. Lack of professional guidance. Yeah, of course. You don't really know what you're getting, and even the people that are guiding you to it don't really know what is going to happen. It's very, very... It's Wild West.
It is, and they'll have on their, they'll have courses, on these platforms for how to do it, and they try to teach you that you can kind of become this expert. You can get in there and kind of take advantage of what other people are missing, in these things, and it's really all. We talked about Thanksgiving, thankfulness, some of that. It's really all playing on this desire to want more, get ahead,
get rich.
Get rich quick. Exactly. Kind of the opposite of that.
Which Warren Buffett said, get rich slowly. And who got rich?
Right.
The guy that thought differently.
Yep. Yep.
And I think that's a key point just to remember, that why is it that people do that? Sometimes they do it because they feel like they're behind. Sometimes they feel like nobody notices them, then nobody cares about them, but they'll care about me all of a sudden if I'm rich and if I'm popular, because look, the rich people are being paid attention to, and it's that desire for something. And quite often, if we really want to be well-liked, we want to be loved. I love that one book, What Happy People Know, says, be the one that gives love. Because if you're giving love, if you need to be loved, you're in trouble, because if somebody decides not to give you love, you're lost. But if you're the one initiating that, then what happens? And if you're just and I love what a pastor friend of mine said one time. He says, "I'm not a public speaker." You know who I'm talking about. Jerry just made this. We always say this, right? He said, "I'm not a public speaker." And we go like, how do you get up there and do the sermon every week? How do you do that, man? And you go, I just love on people. I'm up here. I'm going to stand up here. I'm going to just love on people. Mm-hmm. And that was the whole thing. And everybody loves them as a result of it.
Yeah. I've heard someone say, people are so interested in like, what are my gifts and it's like, if you think about how like other people and how you can benefit other people, there's your gifts. Like they pop up in that, when you stop being inward focused on that, and you turn it outward.
Yeah. A friend of mine used to put it this way. They said, if somebody was in trouble and they needed something really bad, what would they count on you for? What would they turn to you for that you seem to do effortlessly, or the things that you think everybody ought to be able to do this? And you think that because you're able to do it really, really well. Yeah, I think that's so key. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.